All right, so welcome to another video. Today, what we're going to do is we're going to go ahead and take a look at TDOC. It's a big company Kathy Woods has and a huge investment piling it in. And if you want to buy the dip, I'm going to show you an option strategy to do that at a maybe a little more protected and covered way rather than just kind of going in there naked and just trying to go in and buy that stuff. So we're going to go ahead and chat a little bit about that. Keep in mind, none of these are recommendations to buy, sell, or trade anything. It's just my own opinion. We're also going to go ahead and share some other great charts in the Discord channel, so check that out with the link in the description. So I post those in there, and definitely check out some of the live classes that we've done here recently on tradersfly.com. You can see there's a ton of good stuff and material there. We've got some new stuff coming out sometime here soon. All right, so let's go ahead and take a look at TDOC. So TDOC is just not doing well. It sold off here after earnings quite a bit, so we're down a ton, and with that, oh man, the stock is toast. So after earnings for a while, it's got some trouble. But let's say you're thinking, hey, it might fill the gap, it might pop. There might be more investments there coming in. Look, it's just been down so far. I mean, the stock is golden. Whatever your reason is, doesn't really matter. My point here is let me share with you a concept, an idea of like what you could do to go ahead and buy the dip at a maybe more protected way rather than getting burned. Because if it does keep going down, because you're trying to catch a falling knife, if it does go ahead and keep going down, you won't get as burned by doing a more protected strategy. Okay, so what we normally do, let's just say we're trying to sell premium for income. And what we typically will do is let's just go out like 32 days. Okay. And what we'll normally do is kind of sell one and then buy one as a vertical, right? We're trying to sell options. We sell one, then we buy one for protection. So we might typically do a strategy that's something more like, let's go to about a 30 delta, 32, and then buy the 30s right there. And then I'll analyze the trade for you. Let's go to about 20 contracts here as just a general discussion. Okay, so this trade right now would normally cost you about $2,680. Okay, and if we just go ahead and just look at the breakdown on all of this. Okay, so I get a theta of about 13. I got a -9 vega and about 139 delta. So call it about 140 shares of the stock. Now, if this stock does continue to head higher, that's great. And you could pocket about $1,340. That's 67 cents times 20. Okay, and you can see that at the lower right, or sorry, lower left over there in that corner. If I can, there you go, get that off. Okay, so 1340 right there, which is the top or max at expiration right there. Current price, which is the white line, is there, but if it goes up, I can always get out of it early if I'd like. So, but if it goes down a little bit, I'm still okay as long as time keeps eroding. So I got to be in this trade, roughly till, well, June 3rd or June 4th if I'm waiting for expiration, 32 days. But I could get out of it early. But if I get out of it early, and the price went down against me, it's a problem because now I have to pay up for it. So that's the issue, is sometimes doing something like this when you're doing a regular vertical, it's a bit of an issue. So what is it that we could do? Well, what I could do is if I want to be a little more protected, what I'm going to do is change the vertical to a custom, and then I will buy 1 or 2 or 3 extra puts. Okay, and how does that help me? Well, what it does is it smooths out this line. Okay, I could even do 4 if I want. Okay, and now it smooths out that line. So let's just look at a loss analysis. And we'll add an extra price slice. I will go ahead and drag that price slice to the $30 mark. Okay, right at, we're going to change the price to 30. Okay, so now if we go in and look at our loss, that'd be $194 if the stock just keeps going down and goes to 30, like today, right now, right? Because we're not taking into account time decay. But if I didn't have those 4 protections, what it would be is I'd be losing about $1,000. Okay, so I'd be losing about $969 without it. So having those extra 4 contracts right there, losing 200 or losing about 1,000 is a lot better. You're saving about 80% or so in total, on the possible loss. So, but the good news is if the stock does keep going up, you're still winning and you're still doing fine. Now, what's the trade-off of doing this? You're basically paying up a few more bucks to get these 4 extra contracts to smooth out this curve. And if the stock keeps tanking, you're protecting yourself a bit. So what's the cost of this? Well, now my cost is really the profits I would make. It's $696 is really what I would make. Is I'd make $696. Okay. And that's because the protection cost me money, because I'm buying a few cheaper puts to offset my possible loss. Okay. If I just do the regular 20 verticals without the extra puts, I could make, okay, 1320. So, okay, 1320 or 69, let's just call it 700. Okay, so do you want to make 1300 or do you want to make 700? Okay, that is a choice that you have to make. Most people are going to say 1300, but if I say the 1300 is no protection, okay, and the 700 is with insurance or protection on the downside, you know, you have to kind of think about it. What market condition are we in? Are we in a nice, smooth, uptrending market, or are we more in a choppy market? In a choppy market, I'd rather do it with protection and, hey, aim for the 700 because now you're a little more protected, because you're losing maybe only up, you know, 200, maybe 250 with some theta decay. So the downside is you make a little less with the extra protection right here. And you start a little bit with a negative theta. So you start -6 theta. Okay, right here. And as it keeps going up a bit and time decay kicks in, okay, if we keep moving time decay forward, okay, eventually that theta will turn positive right here. It takes a couple days or so. And then if the stock does go in your favor, you're good. You're still protected, you know, and you still can profit from an upside move. And this way, when you're playing a down market, it's not as nasty on the downside for you. And it's a way to kind of play a catch a falling knife without getting too badly burnt. So adding a few extra puts here could be really beneficial. Now, let's say you're dealing with less contracts. Well, let's just go down to about 10 here. And we'll go down to 10 on this side. Well, what you could do is add that extra put still. You know, you get 1 or 2, but you might only need 2 of them now rather than, you know, doing kind of 4 like I had before. You might only need 3 of them even if you want. Just depends how well protected you want to be. The other alternative is, instead of increasing the puts, you could actually just decrease the plus ones, or sorry, the negative ones you have. So that way you still have the additional contracts there. So instead of adding more puts and having a 10 to 12, I have an 8 to 10, right? So you're just kind of reducing the amount of negatives that you have, and that kind of will smooth it out as well. And now I've got kind of a similar construction here, and if it pulls back, it's not too bad. And if it keeps going up, I'm still good, no problem. The issue comes down is if it keeps pulling back and it goes down slow, the theta decay right here can be a little bit of a problem because you are in this sea of death or this quicksand area. So this is a bit of a problem. So there's your quicksand right there in this zone, and you got a little bit of an issue there. So if it pulls back and it's starting to pull back slow, it's a bit of a problem. So you might just want to, hey, take your 40-day, 35-day option, just go, once it gets to 15, go to again 45 or so. But it gives you some time to see, hey, will the stock pop in the next week or two, couple weeks? And if it does, great, then you're fine and you're going to go up there and you could take it off. If it doesn't, starts pulling back slowly, you could give it another week or two. And the big issue and risk is really more time decay, because you've got some insurance, but you don't have to worry about price as much going against you like you do in some of the other trades. But you do have to worry a little bit if that time keeps creeping up on you and you're kind of in this quicksand zone or sea of death and you're just slowly sitting there. So you don't want to let that continue to sit there. So, 10, 12 days before expiration, definitely make a move probably. Otherwise, you could get into some serious trouble because this peak here could be a nasty problem. You don't want to hold these till expiration or forget about it. So anyways, this is one idea here to kind of do a back ratio spread is on TDOC and how you could trade it and play it. Because now you'll be a little more protected and cushioned off on a trade like this. And maybe it gives you an idea for some other things to do in the future as well. Anyway, thanks for joining me. Truly appreciate it. Feel free to reach out to grab a coaching one-on-one session on our website at tradersfly.com. Check out the courses or join the Discord. Thanks again, and I'll see you next time.